Well, if you just joined us this evening, we're discussing retirement and financial planning. My guests are Lesejo Monareng and Palesa Dube. And if you just joined us, thank you for joining us. If you've been with the program, I hope you're enjoying it. I'm going to go to the emails. The first email I want to ask you, he says, from Robert in Parkview, he says, I'm really cash-strapped, and as my policy premium has been increasing, which is now becoming unaffordable, how do I go about cutting the cost for my life insurance? Palesa?
Well, with insurance, it's important to review it, right? From what you've read there, I get the sense that he's probably had these policies for a long time, and what's now starting to kick in are those escalations. And so the insurance then becomes quite expensive, and most of the time, for many people, becomes quite unaffordable. But what has actually been happening is that his life has also been evolving, right? If he had children, for example, perhaps they've finished school. If he had the insurance to provide for, or to pay off a bond and things like that, perhaps he's paid down that bond already. So now you need to ask yourself, do I still need this insurance first of all? Or do you need that same level of insurance? Could you be decreasing it? That's the first thing. So just assess it, review your insurance portfolio on a regular basis. If you're with a good financial planner, you should be looking at this regularly, at least once a year, to say what has changed in your life and how do we then translate that, or how do we need to alter your insurance portfolio as a result?
Well, let's make the point clear. It is a two-way street between your client. It's not just about you making contact with the client. I mean, a good financial advisor will make contact regularly, but there are changes that you don't know about.
Yes.
And if you have a good relationship with your financial advisor, you need to inform the financial advisor, this has happened. We've had a baby, we've changed jobs, we've sold our home, all the different things that you'll only become aware of when you have that meeting, quarterly, half-yearly, whatever the case is. So I think our viewers need to understand it's not just a one-way street. Correct. And because the financial advisor hasn't contacted you that they're not doing the right job, you need to tell them. But Lesejo, just tell me something in terms of, I've got a lot older client base. You cannot believe how some of those premiums were escalated. I mean, we're talking about someone with a 5 million rand policy that's paying 25,000 and now at age 73 is being charged 50,000. It's enormous. You still think, are all the policies now got these review dates?
So automatically when you enter into a contract, they do give you escalation pattern over the probably 10, 15 years. Unfortunately, we only look at the one year, 2 year, and we don't take into account. And also, it depends also what premium pattern you got into. So there's different types. There's ones that will consider your premium based on a fixed rate. There's age-related premiums, so you could be easily paying cheaper premiums if you're 20, 30, 40s, but as soon as you enter into the 60s, 70s, it's a lot higher, more than 8%, 10%. So it's important, I think, to Palesa's point, you need to review what do you actually need, because if you are doing the right things, initially you might have a high life insurance need, but over time, if you are saving and accumulating assets correctly, that need for the rate of cover should be reducing. So if you become self-insured, if I can put it to that, so you need to be saving as well, managing. So at that point, it might not make sense to be paying so much for life cover. It might make sense to be saving to cover what you need. So it's important, but again, this you won't know upfront or by yourself. It's important to engage with your financial advisor because you need to take into account your estate planning as well. What are your liquidity needs? So all of those discussions need to be happening on a at least annual basis. And what I find is that clients don't often tell you when the premiums are expensive. They actually just cancel it. So that's also the worst thing. So if you are getting to a point where this is becoming expensive, reach out first and say, what are my options? What can I do? Engage with your financial planner.
No, it comes back to debt. I always tell people, if you're getting into debt, talk to the people you owe the money to. Don't just leave it, because if you leave it, you're certainly going to run into major problems. If you talk to them, you may be able to restructure, you may be able to get a short moratorium. There's a whole lot of things you can do, but don't just sweep under the carpet. Lesejo Philippa in Emery says, are the tax savings the same as if I contribute to a retirement annuity or a tax-free savings account?
So the tax implications, meaning in your tax-free savings, there is no tax applicable. So whatever interest you earn, whatever growth that's in there, and you withdraw, you're not going to incur any tax. Of course, they give you a limit in terms of how much you can put in there. If you put in more than the allowed limit, you will be paying tax. So from an RA perspective, within the structures, the tax implications are very similar, but the RA is more beneficial in that every year it actually reduces your tax liability. So whatever you're contributing into a retirement annuity or a pension fund or your provident fund actually reduces the tax that you're paying whilst you're putting in there. And also, if you don't qualify for the limit during your contributions, you can also claim that at retirement stage. So the tax in the RA is much more beneficial, and also it's an estate planning. It's a good effective estate planning tool. So what that means is that whatever you accumulate in your retirement savings does not form part of your estate. So meaning you're not going to pay any additional winding up expenses. So the RA, if you had to choose, the RA is a more tax-efficient tool, but obviously you need to consider the restraints, the liquidity constraints. So in an RA, you're not able to take out the money that you would be able to take out in a tax-free. So you just need to be aware between the two
There's
vehicles.
one question on the tax-free saving. Can a parent who has 4 children invest the 36,000 Rand for each child?
That's correct. They can definitely do that.
They're not limited to one contribution.
No.
So they can invest for...
As long as it's in the child's name. So if it's in each child's name, they can contribute the 36,000.
Palissa, I've got an email from June in Durban. She says, how will the elections affect my financial planning?
We're in an interesting year. I think more than half of the globe, actually. Last I saw, it's about 64 countries or so that are going into, will be having elections this year. How will the elections affect your portfolio? Well, if you're a South African, for example, we're having ours at the end of this month. The US is also having their election later this year as well. So typically your portfolios will have some South African exposure, you'll have some offshore exposure, which usually is quite heavily weighted towards the US. But also having said that, Taiwan is, they're also going to elections. Pakistan, there are many countries.
And the UK probably
the
also
UK are going to an election.
Can I answer that simply?
Yeah.
Nothing changes in your financial planning.
Yeah.
The election's got nothing to do with your financial planning.
Yeah.
Whatever happens, you've got to carry on with your plan.
Yeah.
The Sekho, Barry in Middleburg says, I've not seen my financial advisor for some years as I'm retired. How often should a financial advisor see their clients?
Sure. So I find that in your retirement, you actually need to see your financial planner quite often. And the reason is your cash flow, just managing your cash flow and your expenses. So typically you need to be seeing your financial advisor at least once a year. And that's just to check in what's happened. A lot can happen in a 12-month period. We've talked about death. We've talked about new babies. We've talked about a number of things, children graduating. So there's quite a number of things that can happen. But I find that in your post-retirement planning, and what I find is that clients that are retired also have more time, and then they need more money because suddenly they're playing more golf, they have visiting grandchildren. So the cash flow needs to be managed. So at least twice a year, I would say. And the nice thing is you have time as well to actually consider your financial planning. So I would say to Barry, if you haven't seen your financial advisor for some years, that shouldn't be the case. Touch base, understand how your portfolio is going to behave regarding different. So we talked about elections. There's a lot of sensitivity. People are emotional. People are very worried. I get worries about concerns about World War III. Is it going to happen? Is it not going to happen? So it's something that, you know, it's really managing the money and managing the emotions. So
bottom line is, if you're not seeing your financial advisor, change your financial advisor.
Yeah. Absolutely.
And more practically, if I can add, Bryan, for somebody that's retired, assuming that they are in a living annuity, you have one chance during the year for each of your living annuities to revise your income. So you should be seeing your financial planner quite regularly so that you are in time for those changes if you do need to be making changes.
Well, let's say, how would you deal with this question that was posed to me on radio last week? Individuals drawing 6% from their living annuity, they've got 2 different living annuities, but they need a one-off 30,000 Rand.
Yeah.
How would you deal with that? Would you convert that living annuity to annual and then take one payment, because you can't have monthly and annual.
Yeah.
How would you deal with that?
Well, you asked earlier about planning for your pre-retirement and post-retirement. That's an important first step, right? Because when you are in a living annuity, how much you can draw from that living annuity is regulated. A minimum of 2.5% and a maximum of 17.5%. But what happens when there's a leak in the roof, or your tires need to be replaced and you need this 30,000, and your monthly income can't necessarily cover that? So ideally, you need to have at least 2 pots of money. I always advise my clients this way, to say we need to have a discretionary portfolio where you can make those ad hoc withdrawals when a need arises. And then the second pot is your income that's going to be paying or giving you your bread and milk money on an ongoing basis. If you find yourself in a situation where you only have a living annuity, or at least several living annuities, then yes, one way to access a little bit more would be to increase perhaps your withdrawal rate slightly for that 1 year, and yes, look at changing the payout period from a monthly to an annual payment, as an example.
Palesa, I love that, because what you're saying is, even if when you reach retirement, maybe take a little bit of, don't put all into the living annuity, actually pay a little bit of tax, put into discretionary account. Right. Would you agree with that, Lisa?
Absolutely, absolutely, Brian. And I was going to say also, just to add to what Palesa is saying, so once I've seen it with my clients as well, where you've taken, when you've increased it and you made it at level, a higher rate, and chosen the annual payments, it's important to reinvest it so that they also get a monthly payment. So you don't want a client sitting with a lot of money in the bank account and not having, because once you've taken out your annual, you're not going to get another income over the next 12 months. So I always say to clients, you can take it out, but it's important to reinvest it and go back to your monthly, because if you've taken out the annual and it's sitting in your bank account and you still have 12 months worth of expenses ahead of you, you're going to have a problem. So it's important to take out and reinvest, and then opt to get a monthly payment also, just to manage your cash flow.
And then don't forget to go back and revise that withdrawal rate down, because you don't want to maintain it at that
Well, you guys have been great guests. Well, Lisa, I'm going to ask you in the next program, I want to know what sort of questions were asked of you to equip you to enter Financial Plan of the Year, which you won last year. So we want to know a little bit, what were you actually asked? So we'll deal with that in the next program. But returning to my opening remarks about how differently investors view property and equities, I'd just like to remind the viewers that both are long-term and have short-term investment risk. Usually investment properties have some form of gearing, whilst equities are fully paid for. 2022 was a shocking year for equities. 23 was an excellent year. The first 3 months of 24 performed way beyond expectations. A slight pullback in April, and that is what equity markets do. If you look at any long-term graph of equities, you'll see that despite the downs, equities after time always reach new highs. Palesa, Lesejo, thank you for joining me this evening. It's important to note that our program tonight is to provide information and should not be construed as advice. Next week's program, we'll be dealing with short-term insurance. And if you need to get hold of me or Lesejo or Palesa, please call on me. Thank you for watching, and good night.